The Intelligent Investor. Chapter 14. Stock Selection for the Defensive Investor. What if the best investment strategy isn't the most exciting one? What if long-term wealth is built not by chasing trends, but by avoiding unnecessary mistakes? Because honestly, most people approach investing emotionally. They search for the next big thing, explosive growth, fast profits, and exciting opportunities. But Benjamin Graham asks a different question. Which company actually gives investors better value? But Benjamin Graham believed defensive investors should think differently. Not emotionally, not impulsively, rationally, carefully, patiently. And in Chapter 14, Graham explains how defensive investors choose stocks designed for stability, durability, and long-term survival. Because intelligent investing is not just about making money. It's also about protecting yourself emotionally during uncertainty. And honestly, that mindset feels more valuable today than ever. Part 1. What defensive investors should prioritize. Benjamin Graham believed defensive investors should avoid unnecessary complexity. Why? Because emotional decision-making becomes more dangerous when investing strategies become overly complicated. So Graham focused on simplicity and quality. He preferred companies with strong financial positions. He preferred companies with stable earnings, long operating histories, and reasonable debt, and consistent dividends. Notice something important. None of those qualities sound exciting emotionally. And that's exactly the point, because emotionally exciting investments often attract excessive optimism. Meanwhile, stable businesses may quietly compound value over decades. Graham believed defensive investors should focus less on excitement, hype, and prediction, and more on resilience, consistency, and financial strength. Because survival matters enormously in investing. A company surviving difficult periods often becomes far more valuable long-term than a company built entirely on emotional excitement. Part 2. Why financial strength matters so much. Benjamin Graham constantly emphasized financial strength. Why? Because strong finances increase survival probability during uncertainty, and uncertainty always exists. Markets fluctuate, economies change, industries evolve. No company experiences perfect conditions forever. So Graham preferred businesses with strong foundations, for example, manageable debt, healthy earnings, stable operations. Why is this psychologically important? Because weak companies become emotionally dangerous during downturns. When markets panic, financial weakness becomes exposed quickly, and emotionally, many investors cannot tolerate that stress. Fear overwhelms rational thinking. That's why Graham believed defensive investors should prepare before problems happen. Again, not pessimism, preparation, there's a huge difference. Defensive investing is not about assuming disaster constantly, it's about recognizing uncertainty realistically. And honestly, that mindset applies far beyond investing too. Strong foundations create resilience financially, emotionally, professionally, and personally. Strong foundations create resilience. Part 3. The importance of reasonable prices. One of Graham's most important lessons appears again in this chapter. Even strong companies can become poor investments if purchased at irrational prices. This is where many emotional investors struggle. People emotionally fall in love with companies. They become convinced this company is unstoppable. Growth will continue forever. Price no longer matters. But Graham believed valuation always matters eventually, because overpaying creates vulnerability. Again, emotion distorts markets. When optimism becomes extreme, investors stop thinking rationally. They chase momentum, excitement, and emotional confidence. And during euphoric periods, risk often becomes invisible emotionally. That's dangerous. Defensive investors instead ask, is the current price reasonable? Am I paying too much for optimism? Does this investment still provide safety? Again, rationality over excitement. And honestly, that emotional restraint becomes a huge advantage long term. Part 4. Why dividends create stability? Benjamin Graham also preferred companies with reliable dividend histories. Why? Because consistent dividends often reflect profitability, financial discipline, and operational stability. But there's also a psychological advantage. Dividends remind investors that businesses produce real economic value, not just stock price movement. Modern investing culture often feels disconnected from reality. People obsess over charts, hype, predictions, and short-term fluctuations. But Graham constantly reminds investors stocks represent ownership in businesses, and productive businesses generate value over time. This mindset helps defensive investors stay calmer emotionally during volatility, because instead of reacting emotionally, they focus on long-term business quality, stability, and sustainable performance. Again, less emotional noise, more rational focus. Part 5. Why defensive investing often outperforms emotionally. Honestly, this chapter quietly reveals something powerful. Many investors underperform not because their strategy was terrible, but because emotionally they could not stay disciplined. They panic during crashes, chase trends during booms, abandon strategies emotionally. Benjamin Graham believed defensive investing helps reduce emotional self-destruction. Why? Because defensive portfolios are designed for durability, stability, and emotional survivability. And honestly, that matters enormously. A strategy only works long-term if investors can emotionally stick with it during uncertainty. That's why Graham preferred simplicity, diversification, strong companies, and reasonable expectations. Because unrealistic expectations often create emotional disappointment, and emotional disappointment creates impulsive behavior. Again, discipline matters more than excitement, consistency matters more than intensity. And over decades, those qualities become incredibly powerful financially. So, what's the deeper lesson of Chapter 14? Defensive investing is not about avoiding growth, it's about building stability intelligently. Benjamin Graham believed defensive investors should prioritize strong businesses, reasonable prices, financial strength, and emotional discipline. Because long-term investing success often depends less on brilliance and more on avoiding emotional mistakes repeatedly. And honestly, that philosophy may feel boring during speculative market booms, but over time, discipline often outlasts excitement. Next chapter will explore stock selection for enterprising investors, where Benjamin Graham becomes more aggressive, more analytical, and more focused on finding undervalued opportunities hidden beneath market fear. See you in the next chapter. This is Mary's English. Let's keep learning together.